Welcome to the Deep Dive. We're here to break down the source material and pull out the essential insights for you.
That's right.
Today, we're tackling the first quarter 2025 results and business update from FlashYak, or BingEx Limited.
Yep, we've gone through their earnings call.
And our goal is simple. Walk you through the key stuff. Management talked about the financials, the strategy, all of it.
Exactly. Think of it as your fast track to understanding what FlashYak's been up to. We'll start with the big numbers, the headlines from the quarter.
Okay.
And then we'll really dig into the details, the operations, how they're thinking strategically.
All right, let's kick off with that snapshot then.
Yeah.
Q1 2025. FlashYak reported total revenue of 961 million RMB. That's Chinese yuan for reference.
Right. And what kind of jumps out is management stressing, improvements in profitability, even with market competition heating up.
Yeah, they mentioned that competition quite a bit, but the gross margin improved.
It did, yeah, both year over year and quarter over quarter. It hit 13.2% this quarter.
Yeah.
And their adjusted net profit, that came in at 49.6 million RMB.
And order volume.
They clocked 58 million orders in the quarter. And they specifically highlighted continued improvement in the gross margin per order.
Okay, so margin per order is up. But the flip side, you mentioned revenue was down year over year.
Exactly. Total revenue saw a decline compared to last year.
And they tied that directly to fewer fulfilled orders, didn't they, because of that competition?
Yep. That was the reason given. Intensified market competition leading to fewer orders overall.
So it sounds like maybe less volume, but the volume they are doing is more profitable on average. An interesting trade-off.
It really is. Quality over quantity, maybe.
Okay, let's unpack this a bit more. How do those headline numbers break down when we get into the nitty-gritty, and what do they say operationally?
Sure. So the specific financials, total revenue was 960.8 million RMB. Like you said, down from just over a billion, 1,017.7 million in Q1 last year.
Got it.
Cost of revenues also dropped by about 14.7%, down to 834.1 million RMB. Which, kind of tracks with lower revenue and fewer orders.
Of course, yeah.
Gross profit landed at 126.7 million RMB. It's a little bit down from 130.3 million last year.
But, and this is the interesting part you flag, the gross profit margin went up by 1.4 percentage points year over year to that 13.2%.
Exactly. That's the key profitability point. Fewer orders maybe, but better margin on the ones they completed.
Suggests they're not just chasing growth at any cost.
Seems like it. Then you look at operating expenses. Total was 116.7 million RMB. Selling and marketing was the biggest piece of that, around 49.3 million. Then G&A and R&D.
Right.
And their non-GAAP income from operations, stripping out stuff like share-based comp, was 26.6 million RMB. Gives you a clearer view of the core business.
Right. They also mentioned other income took a dip, mainly lower government grants this time around.
Yeah, down to 9.9 million RMB from 19 million last year. So less help from grants.
Okay, so put it all together, the non-GAAP net income.
49.6 million RMB, which again is down from 64.6 million in Q1 2024. So yeah, revenue and net income down year over year, but that underlying per order profitability story is strong.
And cash-wise, they seem okay.
Yeah, pretty solid. Cash, equivalents, restricted cash, short-term investments, altogether it was 787.2 million RMB at quarter end. Gives them room to maneuver.
Definitely need that flexibility.
Yeah.
So connecting the money side to the operations, how are they pulling off this better margin per order, especially when things are so competitive? That must tie into their strategy, right?
Absolutely. It links right back to what they said about their strategic focus.
Okay, let's get into that. What's the core game plan here?
Well, management was pretty clear. The focus is still squarely on their core users and delivering core value. They keep hammering this idea of higher quality, more efficient, dedicated on-demand courier services.
Dedicated being the key word there, separating them from, say, standard food delivery aggregation.
Exactly. And they're trying to refine the details, enhance the user experience, smoother interactions, faster speeds. They mentioned the average delivery time actually improved down to 26 minutes.
Wow, 26 minutes average is pretty fast.
It is.
Are they pushing out geographically as well, expanding?
Yep. They said the service footprint is still growing, especially, they noted, into lower tier cities.
Right. Often a path for growth, maybe slightly less cutthroat competition than the biggest metros sometimes.
Could be. And they've got scale already. Registered riders are nearly 2.86 million and users over 100 million.
Huge numbers. Are they getting specific about who they're targeting within that user base?
They are. They talked about exploring diverse user needs, but specifically called out focusing on the younger generation. They see these users as preferring high quality, timely delivery.
Okay, so tailoring the service.
Yeah, trying to reach them on social platforms, developing task-specific, personalized services. It's not just deliver this package from A to B, it's more nuanced.
Interesting. Sounds like they're getting quite granular with their marketing too, even mentioning things like product placements and TV shows.
Yeah, trying different things to build that brand awareness, especially with audiences who value that quality and reliability aspect.
And they seem confident they can maintain service levels even when things get tough, like bad weather or peak times.
They highlighted that, yeah. Attributing it to their dispatch system, smart route planning, rider training, basically the operational backbone. They described their delivery management as like precise and proactive, real-time tracking and optimization.
That makes sense. You need good sisters for that. And technology must be huge here. What did they say about tech investments?
Oh, yeah, big focus. They mentioned accelerating the private deployment of something called DeepSeek.
DeepSeek, an AI system.
Sounds like it, yeah. They're using it for precise data alignment, fine-tuning algorithms. The goal seems to be smoother interactions, faster responses.
And critically for a delivery business.
Critically, they said it's already improved rider order assignment and dispatch efficiency. In this game, speed and smart routing are everything, right? So that AI piece sounds pretty vital for hitting their efficiency targets.
Definitely. Which brings us back to that competition issue. How exactly are they handling the pressure, especially from the big food delivery players, which clearly impacted their overall order numbers?
Management tackled that head on. They acknowledged the competition, yeah, but noted it's mostly concentrated in like the standard food delivery segment.
Or as FlashAct sees itself differently.
Right. They kept stressing their differentiated model, on-demand, dedicated delivery. The focus is quality, not just being the cheapest or fastest for, a quick meal.
And how does that differentiation show up in who actually uses them?
Good question. They broke down their customer segments, B2B clients, mainly high-end dining, places where speed, safety, quality are non-negotiable. And B2C. It's items needing high security, timeliness, careful handling. They mentioned important documents, delicate things like cakes, high-value electronics, stuff you wouldn't just toss in a generic delivery bag.
All right, so the argument is people choose FlashAct because it's that dedicated, careful, one-to-one service.
That's the core pitch. Careful handling, protection, security, precise timing via that dedicated courier. They feel that because of this niche, the impact of the really fierce competition has been relatively limited on their specific operations, so far at least.
That's a bold claim in this market. But interestingly, they also mentioned a potential upside from all this competition.
Yeah, a bit counterintuitive, but they think the whole competition wave has actually made merchants and users more aware of delivery efficiency and reliability overall.
Ah, raising the bar for everyone.
Exactly, leading to higher user expectations for service quality. And their bet is, well, if everyone starts valuing quality more, that ultimately plays into the hands of a company built on a quality-first model like theirs.
Interesting take. Okay, another absolutely critical piece of the puzzle. The riders. What was the discussion around rider welfare and development?
Oh, this got a lot of airtime on the call. Clearly a major focus. They really emphasized the well-being and career development of the riders.
Recognizing they're essential for that quality service.
Totally. They talked about a comprehensive approach: welfare, protection, career growth, operational support, even community engagement. Trying to build a supportive environment, not just treat them as gig workers.
Are they backing that up with more resources?
They said yes. Investment in rider support is up this year. Enhancing rewards, tangible incentives, encouraging education, expanding career paths, more training access.
So trying to offer more than just the pay per delivery.
Right. The stated goal is professional growth, realizing potential beyond just the financial side.
And there was also that specific government program they're part of for protection.
Correct. Actively participating in that pilot program started back in 2022 by the Ministry of Human Resources and others. It's specifically for occupational injury protection for workers in these newer employment forms, like on-demand delivery.
How does FlashAct implement that?
They use a per-order payment model, and they made a point of saying every delivery includes that occupational injury coverage for the rider.
Provide some peace of mind, I imagine.
Yeah, for the riders, definitely. And they framed it as part of their corporate social responsibility, too.
Okay, so looking forward then, what was the outlook management shared for the rest of 2025?
Pretty consistent message, really. Continue focusing on that core on-demand dedicated courier model. Try to broaden its use cases, apply it to more scenarios, and keep enhancing the service.
And confidence levels.
So they expressed confidence in achieving, sustainable long-term growth as the brand value and user base expand within their niche. Short-term, they expect operational efficiency and user experience to stay relatively stable.
Okay, so let's try and synthesize this for you, the listener. What's the takeaway here? Flash Yak is clearly swimming in a very competitive pool. No doubt about that.
For sure.
But these Q1 results suggest their strategy, that focus on a differentiated, high-quality, dedicated service is actually impacting the bottom line, at least on a per-order basis. Improved margins there, even while the overall order count felt the heat from competition.
Exactly. And those specific investments, like the DeepSeek AI for efficiency and the really significant focus on rider welfare, which you need for quality service, those could be the key things helping them sustain that difference, maybe building a bit of a moat against the purely price-driven players.
Right. And that expansion into lower-tier cities, targeting specific higher-value users, young people wanting quality, high-end businesses, sensitive deliveries, that looks like their plan to find profitable growth away from the main battlefield.
Definitely a niche strategy.
Although it's worth remembering, while gross margin per order looked good, the overall operating margin did dip slightly year over year. Suggests maybe the costs of that differentiation marketing, R&D, maybe rider support are climbing? Something to watch?
Fair point. But that healthy cash position gives them breathing room.
Okay then, time for our outrageous but plausible idea based purely on what we heard in the call details.
All right, let's hear it.
Given Flash Yak's very specific focus and where they're putting their money, maybe a pairs trade?
Okay.
Short a big, maybe more commoditized food delivery platform, one competing mainly on subsidies and low prices. And go long Flash Yak.
Okay. The thesis being?
The thesis is that Flash Yak's differentiated model, catering to those high-value B2B and B2C needs, plus their investments in AI for efficiency, and that whole rider welfare program for quality and loyalty, that this combination will let them capture and hold on to profitable market share.
And demonstrate margin resilience that the pure volume guys might struggle with.
Exactly. The trade assumes their niche focus, and these operational and human capital investments create a durable advantage that maybe the market isn't fully pricing in yet.
Interesting angle. And need I say?
Oh, absolutely. This is purely for illustrative purposes, cooked up just from the call transcript details. Definitely, absolutely not financial advice. Please don't run out and make this trade based on us chatting here.
Right. Always do your own research.
So to wrap it up quickly, Flash Yak's Q1 showed resilient margins per order, even as competition hit overall volume. The strategy is all about that differentiated, high-quality, dedicated delivery.
Backed by tech like DeepSeek and a big focus on writers, they're sticking to their niche, expanding carefully, and aiming for sustainable growth by focusing on those specific high-value segments.
Thanks for joining us for this deep dive into the Flash Yak earnings call.
Yeah, definitely gives you something to think about. Can that focus on premium quality and niche service really win out long-term against the scale and price players? It's a key question in the delivery world right now. If you have thoughts or questions, let us know.